Hey traders, welcome back to the channel. Today I'm going to share a powerful trading strategy that could help you boost your profits significantly. This technique focuses on using candlestick patterns and momentum shifts to spot key turning points in the market. It's straightforward and effective, perfect for traders of all levels. So if you're ready to learn a simple yet potent price action strategy, stick around. Before we dive in, let me show you what you're going to learn in this video. How to spot major key levels that actually work. How to detect market momentum shifts before everyone else. How to predict market reversals before they happen. How to place your entries, stop losses, and profit targets like a pro. How to spot and use market maker traps to your advantage. Stick around because by the end of this video, you'll have all the tools you need to take your trading to the next level. The foundation of this strategy is understanding momentum through candlestick behavior as the price nears significant support and resistance levels. Our goal is to catch those high probability reversals when the market starts losing steam. First things first, let's talk about support and resistance levels. For those of you who are new to trading, these are specific price zones on a chart where the market has a history of reversing direction or pausing. Think of them as barriers that the price struggles to break through. Support is a level where the price tends to find a floor as it falls. It's where buyers step in because they see the price as a bargain, driving the price back up. Resistance, on the other hand, is like a ceiling where the price often struggles to break above because sellers come in, seeing it as a good opportunity to sell. These levels are important because they are watched by many professional traders, and when the market reaches one of these levels, it could signal a significant move or even a reversal. For example, take a look at this support level right here. This is a demand zone, a price area where buyers have consistently come in and pushed the price back up whenever it dips down. It's like a battleground for buyers and sellers, and understanding this can give you an edge in anticipating market movements. Now, here's where the strategy gets interesting. We're not just looking for any old reversal. We want to see signs that the market's momentum slowing down as it approaches these key levels. What does that look like? Well, if you see a series of candlesticks getting progressively smaller as they near a support or resistance level, that's a big clue that the market might be ready to turn around. For example, if we see a big, bold candle followed by a smaller one, and then an even smaller one, it's telling us that the buying or selling pressure is fading. This is often a precursor to a reversal. It's like the market is running out of gas just as it's about to hit that key level. Here's a practical example. Let's say we're looking at a support level and we notice several long wicks on the candles, each getting smaller as they get closer to the level. This indicates that sellers are trying to push the price lower but are losing momentum. When you see this, it's a good sign to start considering a buy position. The first example is the bullish pin bar. Imagine the price is approaching a support level and the candlesticks start getting smaller. This usually means that sellers are losing their grip and the buyers might soon take over. A bullish pin bar is a powerful reversal signal where the candle has a small body and a long lower wick. This formation tells us that sellers tried to push the price down, but buyers stepped in and pushed it back up. It's like the market saying, no, we're not going lower. When you see a bullish pin bar forming at a support level after a series of smaller candles, it indicates that buyers are ready to drive the price higher. The second example is the bullish engulfing bar. This is a two-candle pattern that signifies a strong reversal. As the price approaches a support level and the candles get smaller, indicating sellers are losing momentum, a bullish engulfing bar might form. This pattern happens when a small bearish candle is immediately followed by a larger bullish candle that completely engulfs the previous one. It's like the buyers are saying, enough is enough, we're taking over. The appearance of a bullish engulfing bar at a key support level is a strong indication that the price might reverse and start heading upward. Our third example is the tailed bar. Similar to the bullish pin bar, this pattern has a long tail or wick, but it can occur within a series of candles showing indecision, like dojis or small-bodied candles. When you see a tailed bar forming at a support level, it shows that there was an attempt by sellers to push the price lower, but buyers came in strongly, leaving a long tail below the body of the candle. This action reflects a shift in market sentiment from bearish to bullish. The presence of a tailed bar at a support level, especially after a series of small candlesticks, indicates that buyers are now ready to push the price upwards. Alright, let's switch gears and focus on resistance levels. Think of a resistance level as a ceiling that the price struggles to break through. It's a point where sellers come in strong, preventing the price from going any higher. Understanding how to read the market's behavior as it approaches these levels can give you a real edge in your trading. Imagine the market is climbing up towards a resistance level. As it gets closer, you start to notice the candlesticks getting smaller and smaller. This is a critical observation. When candles shrink in size as they approach a resistance level, it tells us that the buying pressure is fading. It's like a car running out of fuel. As it climbs a steep hill, it starts to slow down because it doesn't have the power to go any higher. The smaller candles are the market's way of saying, we're losing steam up here. A resistance level acts like a ceiling that the price struggles to break above. When the price approaches these levels, you often see some telltale signs that a reversal might be near. Let's go through a few key examples. First up, a quick mention of the bearish pin bar. Remember from our discussion on support levels that a pin bar shows a rejection of higher prices. At a resistance level, a bearish pin bar appears with a long upper wick and a small body near the bottom. This pattern indicates that buyers tried to push higher but were overpowered by sellers. While we've already talked about this in detail, just know that when you see a bearish pin bar at resistance, it's a strong hint that the price could be heading down. Now, let's dive into the bearish engulfing pattern. This two-candle formation happens when a smaller bullish candle is immediately followed by a larger bearish candle that completely engulfs it. Imagine the price is steadily climbing towards a resistance level with a few smaller green candles. Then, all of a sudden, a big red candle appears, swallowing the green one before it. This pattern is like a signal flare, telling us that the sellers have taken control and the price is likely to reverse. It's a powerful reversal signal, especially at a key resistance level. Finally, let's talk about the doji candle. A doji forms when the opening and closing prices are almost identical, creating a candle that looks like a cross or a plus sign. It represents indecision in the market. At a resistance level, after a series of bullish candles, a doji can signal that the buying pressure is exhausted, and the market might be ready to reverse. Think of it like a standoff between buyers and sellers. Nobody's winning, but it often leads to a shift in control, which in this case would favor the sellers. Now, here's a pro tip: always react to what the market is telling you. Don't rush in just because you see one reversal candle. Wait for that additional confirmation, maybe a doji or a bearish engulfing pattern at a resistance level, or a long wicked candle at support. This way, you're stacking the odds in your favor. Now that we've covered how to recognize support and resistance levels and identify key price action signals, let's talk about how to place your entry, set your stop loss, and determine your target. It's important to understand the process of identifying reversal signals and then confirming them before jumping into a trade. Let's dive into some practical entry and exit techniques when you spot a trading opportunity based on momentum loss near key levels. First, imagine you see a loss of momentum near a support level. The candlesticks are getting smaller, indicating the sellers are losing steam. You wait for a confirmation signal, like a bullish pin bar. Once this pin bar forms at the support level, you place your buy entry at the close of the candle, set your stop loss just below the support level, and aim for the next resistance level as your target. Now, let's say you're looking at a resistance level and notice a loss of momentum as the candles get smaller. You wait for a bearish pin bar as your confirmation signal. When this pin bar appears, signaling that buyers have lost control, you place a sell entry at the close of the candle, set your stop loss just above the resistance level, and target the next support level below for your exit. Next, consider an engulfing bar pattern. At a support level, after seeing smaller candles, a bullish engulfing bar forms, engulfing the previous bearish candle. This indicates a strong reversal. Place your buy entry at the close of the engulfing bar, set your stop loss below the support, and your target at the next resistance level. Conversely, at a resistance level, if a bearish engulfing bar appears after a series of smaller bullish candles, it signals that sellers are taking over. You'd place your sell entry at the close of the engulfing bar, set your stop loss above the resistance, and target the next support level below. Finally, if you spot a tailed bar or doji at a key level, these can also serve as confirmation signals. At a support level, a bullish tailed bar or doji shows indecision, but potential for reversal. Place your buy entry at the close, stop loss below the support, and target the next resistance. At a resistance level, a bearish tailed bar or doji indicates possible seller strength. Enter your sell trade at the close, set your stop loss above the resistance, and aim for the next support level. If you're using this strategy, I can almost guarantee that you're on your way to making some serious money. But hold on, before you get too excited, there's something you need to be aware of. The market can play tricks on you, especially those big players, the market makers. They have a few sneaky traps up their sleeves designed to shake you out of your positions and make you nervous. One of the most common traps is called stop loss hunting, and it's something every trader needs to watch out for. So imagine this: you've done your analysis, you've identified a key support level, and you see those candlesticks getting smaller and smaller. It's like a big neon sign flashing reversal ahead. You're feeling confident, and then you spot it. A doji candlestick forms right at the support level. Everything looks perfect, right? You place your buy entry at the close of the doji candle, set your stop loss just below the support level, and target the next resistance level above. But then, out of nowhere, the market drops lower, hits your stop loss, and just as quickly, it reverses and shoots up to your original target. So what just happened? This, my friends, is what we call stop loss hunting. Stop loss hunting is when those big players, think institutional traders and market makers, deliberately push the price just enough to trigger the stop losses of retail traders like us. They do this to create liquidity for their own positions. It's a classic move to take out weak hands before the market moves in the intended direction. It feels like the market is out to get you, but it's just part of the game. So, how do you avoid getting trapped by this sneaky move? Here's the secret. Don't panic and don't rush to re-enter right away. Instead, keep a close eye on the market. If you notice that after your stop loss is hit, the price starts climbing back up and breaks above the high of the doji candlestick, this might have been a stop hunt. Or, if you see another signal forming, like a pin bar, this is another opportunity to re-enter the market. You can consider re-entering the trade with another buy order. But this time, place your stop loss a bit further away, below the low of the stop hunt move. This gives your trade more room and helps you avoid getting caught in the same trap again. The key here is to stay calm and be strategic. Recognize that stop loss hunting is a tactic used by big players, and don't let it shake you out of your position too easily. By waiting for that second confirmation, when another signal forms, you can re-enter with more confidence, knowing that you're aligning with the true direction of the market. Let's look at another sneaky trap that can happen at a resistance level. Imagine the price is climbing towards a strong resistance, and the candlesticks start getting smaller. This tells us that the buyers are losing momentum. Then you see a bearish pin bar forming right at the resistance level, a classic signal that the price could reverse downward. You're ready to jump in. You place your sell entry at the close of the bearish pin bar, set your stop loss just above the resistance level, and target the next support level below. It looks like a textbook trade. But then, just as you get comfortable, the market suddenly spikes up, hits your stop loss, and then quickly reverses downwards to where you expected it to go in the first place. Frustrating, right? This is another example of stop loss hunting. This is when market makers push the price just above the resistance level to trigger stop losses of traders who are short. It's their way of clearing out positions before the market moves in the anticipated direction. It can be annoying, but it's important to stay calm and not let it shake you out. So, how do you handle this? The key is to wait for a second confirmation. After your stop loss is hit, don't rush back in. Watch the market closely. If the price starts to drop again and breaks below the low of the bearish pin bar, this could be a strong indication that the initial spike was just a stop hunt. If you see another powerful signal forming, such as a pin bar, an engulfing bar, or a doji, don't hesitate to re-enter the market. As you can see here, a doji candlestick has formed, so you can consider re-entering the trade with a sell order. This time, place your stop loss a bit higher, above the high of the stop hunt move, to give your trade more room and avoid getting caught again. I hope this video helps you understand how to identify reversals and avoid getting trapped by market makers. If you found this video helpful, don't forget to like and subscribe for more trading tips. Share your thoughts or questions in the comments below. I'd love to hear from you. Thanks for watching, and trade smart.